One of the most difficult decisions you'll need to make in retirement is the pension decision, whether to take the annuity or the lump sum distribution. Hi, welcome back to our video series on retirement basics. Today, we're going to be talking about that pension decision and which option works best for you. My name is Greg Parker with Engrave Wealth Partners. Folks, in the last video, we talked very specifically about how to take care of the retirement problem. That tax problem in retirement is a big one, and it's something that you need to think about in a lot of different ways. But one of the things that will matter when it comes to thinking about the tax problem is where your retirement savings are at. We talked in the last video about the pension and how the pension has two options. One is to obviously choose an annuity benefit, the other to take a lump sum distribution. The pension's a little bit different for Chevron, and the way that we think about that for Chevron employees is important to go through these steps and understand specifically which benefits matter the most to you. Your pension is not something that you've contributed your own financial resources to, but you have contributed your time. And the way your pension benefit is calculated is a function of your current age at the time of retirement, the number of years you've worked for the company, as well as your average salary over the last few years. Now, it's difficult to simply say, this is when the annuity makes the most sense, this is when the lump sum makes the most sense, because we don't know exactly your personal situation. But what might be helpful is if we were to walk through a couple of the goods and bads of both so that you can see why somebody might choose one over the other. Let's start with the annuity option. Why do individuals choose the annuity benefit? Well, the number one reason is that it represents a form of guaranteed monthly ordinary income. Now, guaranteed means that it's guaranteed in this case by the company itself. But the idea that it's going to be a form of monthly ordinary income is rather comforting to a lot of people. Essentially, what that looks like is you would continue to receive a direct deposit to your bank account every month until you're gone or until you and a spouse are gone, depending upon the choice you make at retirement. The annuity option represents a form of safety. Even though the benefit is probably less than your current salary, it's a form of security that a lot of people are happy to receive and see that as something that helps them in retirement. There's one key catch to the annuity you need to know about. That is that the annuity payment, once it's elected, has no inflation adjustment. In other words, when you choose to retire and determine that the annuity is your best fit, the amount of money you receive in that direct deposit will never change. Folks, that represents one of the largest risks you could take in retirement. And the reason is most people looking at retirement from Chevron today are between the ages of 55 and 65. We know that average life expectancy is somewhere around 87 or 88, depending upon male or female. And as a result of that, that means you are likely to live anywhere between 25 and 30 years in retirement on the same fixed income. Folks, if you look at prices over the last 25 years, you know very easily that nothing stays the same. And as prices go higher, it could put a crimp in your lifestyle in the later years of retirement. Not having an inflation adjustment on the annuity means that it is one of the least chosen options when people go into retirement. Now, beyond that, you also need to realize that the annuity, once it's set, cannot be changed. We have clients who will come in a couple of years later and say, hey, I've got my Social Security, I've got other income. I don't really need the annuity right now. Can I pause it or bank it for later? And the answer to that, unfortunately, is not. The annuity represents a form of taxable income every single month, even if you don't need it at the time. Finally, as I mentioned, that ordinary income is important. As we mentioned in the last video, ordinary income is an IRS term that is the same as salary or wages. In other words, it's taxed according to the marginal bracket system. The more you make, the more you pay in taxes. So it makes it difficult with the annuity coming as ordinary income every month to do additional tax planning. When we think about doing some Roth conversions or NUA, we know that we've already got a certain amount of tax that we're going to need to pay that year based on that annuity income. So looking at the annuity option, it's not a popular option. It fits certain criteria and certain people, but not having that inflation adjustment is the number one reason why most people don't choose that option. Well, what makes the difference on the lump sum distribution for most folks is the idea that the lump sum distribution can continue to be deferred tax-wise. Now, this is kind of specific, and you need to understand, in order to get your lump sum distribution and defer the taxes on it, you have to tell the company at the time of retirement that you're moving your pension lump sum into an IRA. They will literally make the check payable to the IRA or do a direct deposit into an IRA account for you. That is what allows you to continue to defer the taxes. Beyond that, I would also say that the lump sum distribution allows you to schedule income only when you need it. When you move that lump sum distribution into an IRA, you can set up some form of regular monthly income that can be adjusted month after month. On months that you may need a little bit more, it's easy to get that. But on months where you don't need as much or don't need any at all, you can absolutely stop the withdrawals, let the money continue to grow in the IRA, and save yourself some time. Now, I think most people know that as long as that lump sum is in an IRA, you also have a wide range of investment options. Inside of an IRA, you can invest your lump sum in stocks, bonds, mutual funds, ETFs, index funds, even bank CDs and money market funds are available inside of an IRA. But the last benefit is one that's also important, and that is because of that continued tax deferral, it leaves room for us to do some additional tax planning. Now we can get creative thinking about the benefits of NUA and Roth conversions to really look at how we can save money on taxes in our later years. That is one of the big reasons why the lump sum distribution is so popular. What's the downside of taking a lump sum distribution? Well, frankly, it's a large amount of money that needs to be managed properly, taking into consideration the risk levels you're comfortable with and making sure it can last for the rest of your retirement. Folks, to have a secure retirement, you've got to be careful with that in the early years of retirement, not taking an excessive level of risk. Now, as I mentioned, the pension benefit is a factor of how long you've worked at the company, your age at the time of retirement, and obviously your average salary. But there's one additional factor that matters with the lump sum distribution, and I think you know where I'm going with this. When we calculate the lump sum distribution, what the company's basically doing is looking at the value of your annuity payments you'd be getting and taking a net present value of those future annuity payments till today. Don't worry, all that really means is, what would the annuity payments be worth if we took them all in one big lump sum today? To do that, you've got to have a discount rate. The discount rate is simply an interest rate used to convert those payments to today's value. The interest rate used by Chevron is the one that is widely recognized and used in most pensions, and that is the rate that is quoted by the Pension Benefit Guaranty Corporation, or the PBGC. The PBGC is a government agency that publishes a basket of rates every single month. That basket consists of 3 different segments, interest rates that are based on certain types of bonds in the marketplace. The black line on the screen represents segment 1. Segment 1 is a basket of bonds with maturities that are shorter in nature. Most of the time, those bonds have maturities somewhere between 1 and 5 years. The blue line, on the other hand, represents a basket of bonds with intermediate maturities. Those maturities typically are 5 to 15 years. And then the yellow line represents the longer maturity bonds, those bonds that are generally 20 to 30 years in maturity. The baskets of bonds consist of both corporate bonds and treasury bonds to give a very broad representation of the marketplace. Interest rates do vary depending upon the maturities, and you can see that on the graph in front of you is that normally the segment 1 rate is the lowest of the 3 rates. The blue segment 2 line typically is in between the other 2, and then the yellow line normally is the highest interest rate, representing those long maturity bonds. Now, I think what every one of you is aware of is what we've seen here year to date in 2022 has been very startling, and that's because we've seen an extremely rapid increase in the level of interest rates for all 3 segments. Now, there's some various factors as to why that's happening, but what you need to know is that the July interest rates that were just released here actually were rates for the month of June. Those rates help determine the segment rates for Chevron retirements in the month of September. So the company is giving you a little bit of an advanced look at what rates are going to be in the future and lets you lock in based on when you want to retire. Looking at those rates for August and September, it's unmistakable that the rates have moved up quite significantly. In fact, when we look at month over month rates, it has not been uncommon to see rates move up anywhere from 1/4 to 1/2% per month. That's a significant rise from what we saw at the end of 2021. And now what we're seeing is the likelihood that those rates will continue to rise. No one has a crystal ball here, but when we look at the factors that have driven rates higher this year, I think you'll be able to see why those lines are moving up so quickly. The black line, the segment 1 rate, is the short maturity bond basket. Those rates are largely correlated to the federal funds rate or the Federal Reserve's interest rate policy. As you know, the Federal Reserve has been raising interest rates quickly this year, especially since May, where we've now seen interest rates rise more than 1.5% over the last 2 months. Folks, that is one of the fastest rate hikes we've ever seen in history. And what it's doing is it's sending that segment 1 rate up in parabolic fashion. Now, the key question is the Fed done? And if you listen to the Federal Reserve interviews that we just heard for the month of July, it's very clear that the Fed expects to raise interest rates again in September, potentially again in October. And according to the markets right now, investors are betting that the Fed will continue to raise rates all the way into December. What that means is continued pressure on short-term interest rates because of Federal Reserve interest rate policy is likely to drive that segment 1 rate even higher. Now, the segment 1 rate is highly correlated to the Federal Reserve's policy, but the segment 2 and 3 rates tend to march to their own drum. What drives segment 2 and 3 rates normally is going to be something along the lines of future economic growth or inflation expectations. We don't see a lot of prospects for fast economic growth today, but what we have seen very clearly over the last 3 to 6 months is a market increase in inflation expectations. Folks, the implied inflation right now coming from the Fed shows that we do expect inflation to continue to rise. In fact, inflation right now running a little over 9% year over year, the highest in more than 40 years. We've not seen signs yet that it is slowing down. And the implication for that is that it should still impact longer maturity bond interest rates, sending them ever higher. This is important. If your retirement date is somewhere in the next 6 to 12 months, you need to be looking at these interest rates and trying to understand how retiring in 1 month can be drastically different from retiring even a month later. If you have not taken the moment to look at these rates and to understand how it affects your retirement, I strongly encourage you to engage with us in an opportunity to do a free, no obligation retirement optimization plan. That plan is going to answer some of the basic questions about retirement, but it's also going to help you put some numbers on what those interest rates are doing to your pension and which benefit is going to help you the most. In order to build that optimization, we simply need to look at your current pension benefit projection, your savings plan at Fidelity, and any other retirement assets or investments you have, so that we can help you get a handle on what that option is going to look like when we think about lump sum distributions. Folks, to get this information, you can hit the website at engravewealth.com, click the Start Your Free Plan button. We'll be more than happy to reach out, collect the information from you in a secure, confidential format. We can produce the plan in 24 to 48 hours, schedule a time to meet with you via Zoom or in person in our office, and make sure that your questions get answered. Folks, when we look at plans like this, it is very clear nobody, when they're thinking about retirement plans to fail, they simply fail to plan. Don't let that happen. Reach out, let us schedule some time to visit with you about this, and we will answer those questions. Thanks for watching the video. Jump into the next one where we're going to be talking about tax savings, thinking about the benefits of NUA and how that can help. Thanks so much.